Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
Just about 2 minutes away from the end of the trading day. Caroline Hyde, Taylor Riggs, Sonali, Basak, counting you down to the closing bell. Here to take us beyond that bell. A global simulcast. We're joined by Katie Greifeld, filling in for Carol Basak and Tim Stenevik, bringing together our Bloomberg Television, Radio and YouTube audiences as we really look through what has been a day of declines across the broader benchmarks and declines across the broader asset classes, Katie.
Absolutely. If you look at just the S&P 500, it felt like we fell right at 1030 and we stayed there. It feels like the story this summer has been what can happen in the last 2 hours of trading, a lot of intraday volatility. Not so much today. It was just lower all day.
Volatility when you think about the return to office conversations, Katie, that we've been having here on this program, as Caroline was talking a lot about that New York Post story looking at Goldman trying to return people to the office. We've been here 5 days a week. It's not so bad, but I understand the frustrations. We'll continue to talk a lot about that story as we bring it back to these markets, Sonali. And yields on the front end, you're still rising. I've heard a lot of people saying that the path forward continues to be higher, though Jeremy Signal, of course, saying that maybe that 350 number will hold. Maybe that is the peak.
It's interesting to think about that 350 because rate expectations have gone up. There's more of a 70% chance of that 75% rate hike now. More consensus among the markets, more consensus in the language among the Fed presidents, and you see that reflected in the market movement today.
But less consensus among market participants still. I mean, yes, there seems to be more selling, but the strategists are still so bifurcated. You still have the JP Morgans being that it's time to be bullish, whereas Credit Suisse's note globally bearish on stock markets today, just adding to the Morgan Stanleys, the Bank of Americas of this world. We are but 6 seconds until the market starts to settle out. We're down by 44 points, let's call it, on the S&P 500, off by 1.1%. So a third day of losses for the main US benchmark. The Nasdaq off by 1.1% as well. Managed to come off of its lows, which was at one point down by about 2%, but still 134 points to the downside. Dow Jones off by almost a percentage point, down 309 points overall. And let's have a little look at what happened on the Russell 2000, because small caps have been in the eye of the storm as well, and we're off by 1.5 percentage points on the day overall, Katie.
A third day of losses, a third day of pretty broad-based selling. If you look at the S&P 500 in particular, just 67 stocks managed to finish in the green. Over 400, of course, closing in the red. So widespread pain there, Taylor.
You rarely see a lot of that pain on the individual sector level as well. For a radio audience, the sector best performers, the sector worst performers. There's only one sector in the green, and it's only 0.08%. The banking index, as you think about maybe yields higher and the path for maybe better profitability for the banks. Otherwise, it is all the way red. I'll take you down to some of the bottom. It feels like really big tech and some of the classic reopening risk on trades that are under pressure here. Semiconductors, materials. Otherwise, it's transportation, auto, and energy. Those sectors are off 2 to about 3.5%, Katie.
Just to mix it up, I did find one stock in the green. That, of course, is Best Buy reporting earnings. They beat profit estimates. Of course, that comes a month after they cut their forecast, warned us a little bit. But it was a beat nonetheless, and you did see shares about 1.6% higher, which feels notable on a day like today. Moving on, you did have AMD. This is interesting. They introduced a new line of processors, the Ryzen 7000. And actually, analysts were broadly positive both on this chip's performance and AMD's execution. It did not help shares at all, down about 1.8%. Twitter, I was saying to Tim Stenevik before this started, I get a little shaky if I go too long without talking about Elon Musk. This story is the story that keeps on giving. We all know it. Musk's lawyers saying that the whistleblower revelations on bots means that Twitter has breached the terms of Musk's agreement to buy the company. Twitter, of course, doesn't agree. We're going to see how that one plays out, but shares lower by almost 2%. Just to round it out, I did want to throw an energy name up there, Halliburton. Of course, the entire energy sector is lower today. You do have crude oil down about 5%, hurting the likes of Halliburton.
And let's go straight to it. Let's do commodities right now, because I have the global macro movers, Katie. And as you say, WTI off by 5%, Brent off by 5.4%. This really comes as maybe we dial back a bit of our anxiety around what's happening in terms of violence in Baghdad and Iraq and the output there. But really, it felt more also about a global quandary. Are we going to see a global global growth slow down? Are we therefore going to need less of a demand side picture as well? So supply side, demand side feeding together to bring oil lower. We saw, across the board, every major commodity down. Metals fell. We're also worried about the China outlook there. We're also seeing the likes of soft commodities on the downside, cotton falling big time. We're seeing overall milk down, natural gas down 2.3% after significant falls in European gas prices, down about 20% as Germany really starts to add to ensure that its supplies are being built up, and what that means therefore for a potential of riding out this winter relatively unscathed thus far. We're looking at the FX market, just a sea of red as well. Strong US dollar as we think of a more hawkish Federal Reserve, strong euro as well as we think of a more hawkish ECB, and we see the Canadian dollar weaken on the back of the oil sell-off. You also see, of course, the Aussie dollar weaken as we see a sell-off in metals and some of that global growth story. Mixed picture when it comes to sovereign bonds overall. UK gilts, you rise in the 30-year in the long end, but a little bit of a bid for the belly of the curve when it comes to Australian and Japanese debt. Taylor.
You see that a little bit on the long end here, Caroline, within full faith and credit. Some buying for price higher, yield lower, particularly on 20s and 30s. But again, as always, it's the front end of the curve that yields are rising and prices falling now back up to 346 that we've talked about on a 2-year. So really firmly surpassing the June 14th highs of this year and going back to highs on that 2-year yield that we now haven't seen since about 2007. So I guess the steepening here that continues with yields on the front end higher, Sonali, yields on the long end much lower.
Yeah, and talking about yields, I want to tie in more commentary from Thomas Barkin, president of the Federal Reserve Bank of Richmond. He reiterated the central bank's commitment to curbing inflation while acknowledging fears of recession.
The pace of when we get back to our target, which is 2%, is uncertain. But as a result, our commitment to bring inflation down, which hopefully you welcome, leads to worries about a recession. And I understand why.
So if you're worried about a recession, the question is how long, how far, and what does that mean for rate cuts? Because on one hand, we're thinking about absolute levels, but there's a lot of question around how long some of this pressure on the market will last for.
And a topic I've been interested in is just comparing and contrasting the stance of the Fed to that of the ECB and other central banks, particularly in Europe, because if we do enter a recession and you do have a Federal Reserve that's cutting, again, I mean, Caroline, I know you've been all over this, the inflation picture elsewhere in Europe, those central banks can't really afford to take their foot off the gas. So you could see really a break apart in the different stances of these central banks.
We are getting some commentary on further sort of corporate spending, consumer spending, Caroline, which I know that you and I will both try to tackle here on this program. We're getting some of the quarterly results from HP Enterprise, of course. We are seeing the third quarter net revenue spot in line, $6.9 billion. Down full year, as we're thinking about the top and the bottom line for the full year. Adjusted EPS full year 196 to 204, spot in line with estimates. They'd previously seen 196 to 210. So perhaps maybe a narrowing, a coming down of sort of the higher end of the estimates, but they're maintaining the floor of that and really looking at least next quarter, those fourth quarter adjusted EPS of 52 to 60 cents. Again, right spot in line of an estimate of about 59 cents or so. Going through some of the free cash flow numbers that look a little bit light in terms of the full year, but overall maintaining that quarterly dividend and a number here that looks just right here in line with estimates. That might explain the unch in the aftermarkets trading.
A big fat unch. Let's have a look at what's happening with Chewy, of course, big pet company. I know I've got a lot of pet lovers on the lineup with me today, all of you animal lovers. I'm looking at what is actually kind of a lackluster report coming from what is a $16 billion company. We're seeing shares falling after hours as net sales come in just ever so slightly light, $2.43 billion. The market had been expecting $2.45. The adjusted EBITDA came in at $83 million. The estimate had been for $13 million, so that's well ahead. But overall, when you dig into some of the numbers, they're saying the gross margin was expanding, actually, 60 basis points year over year. Net income managed to come in at $22.3 million. But this is a company that says that they're proud of their second quarter, their ability to deliver double-digit top-line growth, margin expansion. Interesting, they call it a rapidly evolving macro environment.
Yeah, rapidly evolving, meaning that customers are having a hard time spending their discretionary income on their pets because pets can be expensive. You're seeing the shares drop now almost 9%, kind of whipsawing aftermarket. Remember, we saw very similar reactions when we talked to Petco a couple weeks ago. The question is, how long does inflation continue to eat into spending, especially when, you know, human food is expensive?
Yeah, that's interesting, though. I think we've spoken, Katie, with some other pet sort of owners and companies who've said that this has been such a COVID secular shift. And once people start spending money on pets, it's really sticky, actually. It's really hard to take them away from that. And they, in many cases, maybe myself included, would rather starve in order to feed that pet. But I'll let maybe some of my personal opinions to the side here as we continue to focus on the data.
I was going to say, I still feel like we're buying an industrial amount of cat food from Chewy specifically. But guys, we got to run, a lot to digest. Chewy shares off by about 8% at the moment. But that does it today for our cross-platform coverage of the market close on Bloomberg Television, Radio, and YouTube. We're going to be back tomorrow at the same time, same place.